Hey, how's it going, guys? Welcome back to the Module 3 of Options Trading Foundation, the complete options trading course for beginners. Module 3 is all about the spread strategies in options trading. In this video, the submodule 3.2, we will continue with the debit spreads and talk about another classic debit spread strategy, the bear put spread. Alright, let's get started. In the previous video, we mentioned that the best time to use a bull-call spread is when you believe the underlying stock will go up, but the call option is overpriced. So what if you believe the stock will go down instead? What if you want to profit from a potential bearish move in a stock, but the put option is too expensive to own? Then that is exactly where the bear put spread comes into play. The best time to use a bear put spread is when you see a potential negative catalyst in a company and you expect the stock price will go down or underperform the market index in a certain time frame. However, the stock's put option is overpriced due to the short-term overwhelming bearish view over the company. Then in such situations, a bear put spread should be on the top of your playbook. It can help you profit from the potential bearish move. But also, it can help you avoid overpaying for those expensive put options and greatly reduce your risk on the trade. Same as a bull call spread, a bear put spread also has two trade legs. In order to execute a complete bear put spread, first, you need to buy or long one put option with a higher strike price. Second, you need to short one put option on the same underlying stock with a lower strike price. Here are some of the important details to notice when it comes to bear put spread. All of the options are put options. No call options are involved. Both strike prices should be lower than the current stock price, which means all those put options should be out of the money. Also, those put options in both trade legs should have exactly the same expiration date. And the same as the bull call spread, the ratio of the number of the put option contracts you buy and sell should be strictly 1-to-1. Alright, after we go through the basics of how a bear put spread works, now let's take a look at one case study with a real stock example. Johnson & Johnson, one of the most popular stocks, is currently traded at $145 in October 2020. Recently, the company is developing a new drug for early-stage cancer patients. Right now, this new drug is under FDA's review over the next 5 months. After you did some research, you have a pretty bearish or negative view over the drug approval from the FDA. So you want to short Johnson & Johnson stock and make some potential profits from this potential bad news. However, J&J is a pretty popular stock for short sellers. The put option premium is pretty high, especially those contracts expiring within the 5 to 6 months. You want to take this opportunity and profit from the potential crash on J&J stock, but you don't want to risk too much over the expensive put option premiums. So the best strategy to deal with such situation is to use the bear put spread, and this is how it works. First, you buy one of Johnson & Johnson's March 2021 put option at a $135 strike. Currently, this put option is traded at $8.8 per contract. Then, at the same time, you sell one of Johnson & Johnson's March 2021 put option at a $125 strike. Because this strike price is lower and further away from the current stock price, the premium will be slightly cheaper, traded at a $7.4 per contract. So, after you execute this bear put spread trade, you will now have a net debit of $140 out of your account. This is the cost of this trade. Your total maximum risk will also be your net debit, which is $140. Your maximum reward will be the difference in those two strike prices multiplied by 100 and minus the net debit. After the calculation, we can get the total maximum potential reward for this trade is $860. And finally, the break-even price is your lowest strike price minus your net debit divided by 100. In this trade, we can calculate the break-even price to be $133.6. Alright, after we calculate all these important numbers, we can now draw the risk graph for this bear put spread trade. This is how the profit and loss line looks like for this trade. First, we have the higher strike at the 135 and the lower strike at the 125. Then we have the break-even price at the $133.6, which is between these two strike prices. So, if Johnson & Johnson stock price goes down and stays below the break-even price, you will be in the profit zone. If the stock price breaks down and moves below the lower strike price $125, your trade will reach the maximum profits, which is $860. On the other hand, if the stock price stays above the break-even price, your entire trade will be in losses. If the stock price closes above $135 by the expiration date, you will hit the maximum losses on this trade, which is $140. From this risk graph, we can easily see that the best case scenario for a bear put spread is when the underlying stock price goes down and stays below the lower strike price before expiration. This is where you can reach the maximum profits. And the worst case scenario is when the stop price stays above the higher strike until the expiration date, and you will end up with taking the maximum losses. For beginners, how to choose the higher and the lower strike prices for a bear put spread is very similar to bull call spread what we discussed in the previous module. Basically, you also follow the 3 rules. First, always make sure both of your put options in your 2 trade legs are out of the money, which means both of the strike prices of your put options should be lower than the current underlying stop price. Second, always use your 3 to 6 month short-term price target as your lower strike price. And third, your higher strike price should be determined by your maximum risk per trade. This is very crucial to your position sizing and your risk management. Alright, since a bear put spread is considered a bearish trade, let's compare this strategy with directly buying a put option on the same Johnson & Johnson stock with the strike price at $135, which is the higher strike. Your maximum risk for a bear put spread is only limited to $140, but if you buy a put option at a $135 strike, your potential loss could go up to $880, which is way much higher than the bear put. Your maximum reward for a bear put spread trade is limited to $860, while directly buying a put option can give you virtually unlimited potential reward. But the maximum downside of a stock can go to is 0. The total cost for taking a bear put trade is much lower compared with the directly buying a put option. And finally, the break-even price for bear put is at $133.6. But if you're directly buying a put option at a $135 strike, your break-even price will be at $126.2, which is much lower than the bear put trade. Because it is a bearish trade, the higher your break-even price is, the higher chance your trade will be in the profit zone, which means taking a bear put spread trade can increase your probability of making profits. As we can see from this comparison, both a bearish trade, but the bear put spread is a way much better strategy compared with just directly buying the expensive overpriced put option. Here's a quick summary of the bear put spread. It is considered a bearish setup, meaning you only take a bear put spread when you believe the underlying stock price will go down. Same as a bull call spread, the bear put spread is also a debit spread strategy. When you take a bear put trade, you will have money out of your account first. Your total risk will be limited, your total reward will also be limited. If used properly, a bear put usually has a high reward to risk ratio. And on top of that, it can also help you reduce the cost of your trade. Lower cost means lower risk. A bear put trade can also increase your break-even price, and that means you will have a higher chance to be in the profit zone. Out of the money put options are strongly preferred to construct a bear put spread trade. For all the beginners, if you never traded bear put spread before, I highly recommend you to start with those put options with a longer than 3-month expiration period. As mentioned in the previous module, options with longer time periods are much easier to manage due to the low rate of time decay. And also, they generally have a higher premiums, so it can indirectly force beginners to take smaller positions. Alright, we have finally completed the first half of Module 3, the debit spread. Let's do a quick recap on what we have discussed so far about the debit spread before we move on. A debit spread is a paired trade strategy that traders simultaneously buy an option with a higher premium and sell an option with a lower premium over the same underlying stock. The debit means such trades will take money out of your account first. There are 2 debit spread trades in 2 different directions. When you are bullish on a stock, you can take a bull call spread. And when you are bearish on a stock, you can take the bear put spread. There are 3 main purposes of using debit spread, or you can see them as the top 3 benefits of using debit spread. First, reduce cost. Debit spread can help traders reduce the premium cost from those overpriced options, and the lower cost means less risk. Second, readjust the break-even price. Debit spread can help traders readjust the break-even price into their favor and increase the probability to be in the profit zone. And finally, debit spread has a high reward-to-risk ratio. It can help traders to take advantage of those potential catalysts on our stock in both directions without taking too much risk. Alright, that will be the end of this video, also the end of the debit spread. In the next 2 videos, we'll move on to another extremely important options trading strategy, the credit spread. If you are new to this channel, my name is Vic. I hope you guys enjoyed the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.